General Electric, GE, has seen its share price falter over the last year, due to a magnitude of reasons. Its share price has fallen so much that a lot of negatives are priced in right now, which means that further downwards pressure could be limited. Some of General Electric's bonds trade well below par right now, which has led to substantial yields on some of General Electric's bonds. This provides opportunities for income-focused investors, as well as for General Electric itself, as General Electric could lower its debt levels substantially by repurchasing these bonds below fair value. 2018 has been a very rough year for General Electric and its shareholders. The company cut its dividend by more than 90%, after cutting the dividend by 50% in late 2017. General Electric was faced with accounting probes, which are not yet resolved, and which were expanded this fall. The company had to endure a massive $22 billion write-down, profits were substantially lower than what was anticipated earlier on, and General Electric's debt was downgraded. All of this, and possibly much more, seems to be priced into General Electric's shares right now. Shares lost roughly 80% of their value over the last 2 years, crashing from $32 to $7. With General Electric's market capitalization being cut by more than 3/4, many problems are already accounted for. The big decline in General Electric's share price has made some noted bears step to the sideline, as they feel that shares are now trading around fair value. The low share price has also led to some insider buying, which is a good sign that management is confident about the company's future. One of the arguments for many former bulls to sell their shares over the last couple of weeks has been the declining share price itself, due to 2 reasons. Some investors can't stomach huge share price declines in their holdings and prefer to exit positions at a loss, even if the sale happens while shares are possibly undervalued. Another reason is tax loss selling. Everyone who bought shares over the last couple of years sits on substantial losses. Realizing these before the end of the year can be advantageous. Tax loss selling pressure should diminish over the coming weeks, which could mean some relief for General Electric's share price. With an EPS estimate, fiscal 2020, of 99 cents and an average price target of $12.61, General Electric could be undervalued right here. If analysts are right, shares trade at just 7.2 times 2020's profits and shares have upside potential of 77% to the consensus price target. General Electric's shares are not suitable for income investors or for those that seek non-volatile investments, but they could be suitable for investors looking for a turnaround value story. Much of the share price decline and the weak sentiment has been driven by worries about General Electric's leverage situation. The company holds massive amounts of debt, and many investors are worried that the value of General Electric's assets could be lower than its liabilities. These worries are based on the following calculation. General Electric had liabilities totaling $263 billion on its balance sheet at the end of Q3, whereas assets total $312 billion, for an equity position of $49 billion. A meaningful portion of General Electric's assets consists of goodwill, though, which makes up $60 billion. General Electric also holds other intangible assets, $19 billion, on its balance sheet. Its total tangible assets equal $233 billion, which is substantially less than the $263 billion in liabilities. General Electric's tangible equity thus stands at a negative $30 billion right now, which makes some commenters worry about a possible bankruptcy. I believe that this is false, though, due to 2 reasons. First, companies do not necessarily go bankrupt just because their tangible book value, or even their total book value, is negative. There are a number of companies with a negative book value that are doing fine, as this does not necessarily go hand in hand with liquidity issues. Philip Morris, PM, for example, has a negative book value, not only tangible book value, and its shares have done well over the last decade nevertheless. The second reason why General Electric's investors don't have to worry about assets being worth less than liabilities is that the goodwill and intangibles are not worthless just because they are intangible. These intangible assets include items such as patents, trademarks, brand names, copyrights, and some R&D items. Many of these items have a real value and could be sold, for example patents to a competitor, or trademarks to a company that wants to enter a certain market. The majority of General Electric's goodwill belongs to its aviation, oil, and gas, and healthcare segments. These are usually considered the stronger, higher value segments, which have fewer problems and are more profitable than other segments, for example power. We can thus assume that the strength of these segments is reflected in the worth of the goodwill on General Electric's balance sheet, and that General Electric could indeed capture a substantial portion of the book value in an asset sale. Non-goodwill intangibles consist of items such as patents, worth $6 billion, 10Q page 81. General Electric writes down these assets as they lose value over time. General Electric has also written down its goodwill in some cases. For example, the $21 billion charge in its power segment during Q3, it thus seems likely that the intangibles, goodwill and other intangibles, are valued more or less correctly, in line with the respective market value. On top of that, there are, in all likelihood, some assets on General Electric's balance sheet where book value is lower than the actual, true value. This is oftentimes the case for real estate, which usually increases in value, whereas accounting rules force General Electric to write down the value on its balance sheet. If, for example, General Electric bought office space for $100 million 10 years ago, this office space has a book value of less than $100 million now, due to write-downs. In reality, it will be worth much more than $100 million, though, as property prices have risen considerably over the last decade. General Electric likely owns a substantial amount of these hidden reserves, assets where the true value is higher than the book value, as the company holds properties all around the world. To sum up, General Electric's intangible assets do have value, and there are likely substantial hidden reserves that are not accounted for in General Electric's balance sheet. Investors thus don't have to worry about the fact that tangible book value is negative, I believe. General Electric's management has been pretty clear on its plan to prioritize deleveraging going forward. This makes sense, as this is an issue that gets a lot of attention from shareholders and analysts. General Electric deleveraging source, General Electric statement. Selling assets, such as parts of its stake in Baker Hughes, BHGE, frees up cash that can be used to lower General Electric's debt. General Electric can do this in two ways. General Electric can hold cash until some of its bonds mature and pay them down. As General Electric does not have to refinance the debt in this scenario, its debt levels decline over time. General Electric can also decide to lower its debt more aggressively by repurchasing debt, either through private deals, through tender offers, through Dutch auctions, or by buying up bonds when they are traded publicly. This has some advantages. General Electric does not have to wait for bonds to mature. The company can bring down its debt levels immediately. On top of that, General Electric would benefit from the fact that some of its bonds trade below par. If bonds with a book value of $100 are bought back at $90, General Electric has brought down its debt by $100 despite spending only $90. For each dollar that the company spends, it lowers its debt by $1.11. The GE note from this image trades well below par, for example. These notes traded well above par throughout most of the last 5 years, but have fallen considerably over the last couple of months. This note has a quite high coupon of 8.35%, yield to maturity is even higher, at 11.7%. If General Electric uses $100 million to purchase these notes, the company would be able to buy notes with a book value of $110 million. By spending $100 million, General Electric would not only lower its debt by $110 million, though, but the company would also save a substantial amount of interest. A decline of $110 million in this note, book value, would go hand in hand with an interest expense reduction of $9.2 million, for a cash-on-cash return of 9.2%, as General Electric has only spent $100 million to reduce its notes by $110 million. By opting for a more aggressive approach of repurchasing its notes or bonds, General Electric can thus deleverage more effectively, as the company can buy its debt below book value, and as General Electric can opt for those bonds where the returns are the best, in terms of interest saved. General Electric has massive liquidity, thanks to a large cash sum on its balance sheet and massive credit lines, more than $40 billion of undrawn capacity. It thus seems likely that the company would be able to lower its debt considerably and effectively by buying back its debt opportunistically, where management finds notes that trade well below par, which boosts the effectiveness of each dollar that General Electric spends on deleveraging. The GE note from above could be interesting for income investors as well. As explained earlier in this article, I believe that a bankruptcy is very unlikely, despite all of the problems that General Electric faces. Investors who buy this bond get a cash-on-cash yield of 9.2% and a yield to maturity of 11.7%, which includes capital appreciation, assuming shares are paid back at $100 once they mature. For a company that has an investment-grade credit rating, such as General Electric, that is a quite high bond yield, which could be attractive for income-oriented investors. Takeaway: General Electric has been hit hard during 2018. But right now so many negatives are priced in that future downside seems limited, especially as tax loss selling will diminish soon. Investors should, I believe, not worry about General Electric's tangible book value too much, as the true, underlying value of General Electric's assets is likely substantially higher than its tangible book value. Deleveraging is one of management's top priorities, and rightfully so. Through repurchasing debt below par, General Electric could boost the effectiveness of its deleveraging efforts. General Electric's shares are a turnaround value play, but some of its notes and bonds could be solid income investments, especially when they can be bought below par, which provides for attractive yields from this investment-grade rated company.